So what's going on, guys? Ace Alfala here, founder and CEO of FMO Media. We have two guests from Supreme Lending. Hey, before I get kicked off, Todd, Kyle, why don't you give us a quick rundown with who you guys are, what you're about, and what Supreme Lending's about?
I've been in the mortgage side of the business for a little over 10 years now, but I was a real estate broker for 10 as well prior to that. So about 20 years experience in the real estate mortgage type world altogether, right? So Supreme Lending is a large direct lender that we partnered with last year in August of last year, and it's been a great team, great for us because they kind of help us. We kind of have our own little like mini franchise is the best way to put it, right? We have our own little thing that we run our own business within a big business. We have all the support there. So yeah, that's, I started out in the real estate side of this business, which kind of gives me a little bit of insight of what the realtor partners are looking for when we're out talking to them. And then I got into the mortgage side, like I said, about 10 years ago. And then I ended up teaching real estate to new realtors. And that's actually how I met Kyle. That's how he got introduced to the business. So go ahead.
Right. Yeah. I was a musician for a long time, over a decade, just doing music in Nashville. We moved to New England, and we, being my wife and I, and our children, we moved to New England, and I was continuing to do mostly like film and television music. We, I have built a studio in our house, and for the most part, it was like working out okay. But I was just a little burnt out on the music industry and trying to figure out how to move the needle and advance in my career. I was just kind of tired, man. So I dropped out of college to pursue music. So real estate was like one of the only things that I thought of as like, oh, maybe I can make a living there being a dum-dum. Like, I don't have a degree. I could go do real estate. That's like spoken as a person who's truly ignorant of like anything real estate related, because the last thing you can be is dumb and do real estate.
Yeah.
So I started taking the real estate course at our community college, and Todd was teaching it. So I thought I wanted to be an agent. Learned pretty quickly I did not want to be a real estate agent. It felt more like a lateral move to me. Real estate agents are a lot like musicians. They're independent contractors. You're promoting yourself. It's deal to deal. You're constantly hustling. So I wanted more of a change than that. I knew that Todd was a loan officer. I really didn't know what that meant, but I didn't want to have wasted the last 3 months of my life. So as soon as the class was over, I asked Todd out to lunch, and I just wanted to pick his brain about what he did for work and what that looked like. What does the mortgage side or financing side of it look like? And he gave me an opportunity to come learn it. It's really hard to explain what the mortgage side is like over a couple beers. So he was like, man, come spend time with me in the office and just hang around. And that's what I did. And we've been doing that for years now.
Yeah. And kind of how I transitioned into the mortgage side of it from the real estate was, and when the mortgage industry, the real estate industry kind of declined after 2006, we had that real, crash in the real estate market. I had 25 realtors working for me at the time as a real estate broker, and I lost 10 of them, right? So down to 15 agents, and I was struggling too. I mean, it was a really difficult time in the industry, and I remembered other real estate companies that were able to do both mortgages and real estate, right? So I was like, well, I really like and enjoy the mortgage side of this. I'd like to know more about it. How can I kind of incorporate that into my existing real estate company? That was the thought that I had at the time. I started exploring it, asking questions, talking to loan officers that I had been dealing with when I was a realtor who I liked, and I was given an opportunity to get into the mortgage side of it at a local credit union. And so I was offered a nice offer, and I thought, well, stability would be nice. A little bit more of a paycheck, consistent paycheck in this market. What I didn't understand was that I was going to have to close down my real estate office at the time. They didn't tell me that when they offered me the job. So I told them I couldn't take the job initially because I had those 15 agents still working for me, and I felt loyal to them because they were loyal to me. I did find somebody that wanted to buy my business, my real estate business. And about a year later, I reached back out to the credit union and saw if the opportunity was still there, and they said yes. So I was able to sell the business off, get into the credit union, and to start my career as a loan officer. And what was funny about this, that what I learned was that I thought I knew a lot about mortgages because I was in real estate for 10 years. So I'm like, this is, I kind of have a pretty good understanding. This would be a pretty easy transition. And then I got into the industry and I was like, oh my God, I know nothing. It was so much more to know than I thought,
Yeah.
The first 3 years, it was just kind of, going through the paces of learning how to take an application and learn about understanding how to do debt ratios of a client and, kind of what do I need to have to get an application. And, they don't teach you much at a credit union, unfortunately, but once I got out into the real world of direct lending, I learned a lot. I mean, the first 3 months, I learned more in 3 months in direct lending than I did in the 3 years at the credit union, but the rest is kind of history. Kind of developed, I started to learn what worked for my style and who I am and what was the best fit for me and my clients and my realtor partners. So, but that's kind of how I ended up in the mortgage world. And I finally gave up my real estate broker's license. I don't know, about 4 years ago, I finally said, well, I'm never going back to real estate at this point. I like this part of it. I enjoy the mortgage side of it. So I've kind of stuck with it since then.
That's super interesting. Because usually you think, the realtor side is like the, I don't know, I guess like you said, like a musician, right? It's like the sexy rock stars, right? The mortgage loan officers are not usually the people who like are in front of the camera and kind of getting all the praise and stuff. And I mean, the real question I have is, Todd, when you took Kyle out for that lunch, was it like the Wolf of Wall Street where you showed him like a $72,000 check? You're like, come work for me.
Yeah, we did a lot of cocaine.
I think it was almost the opposite. I was kind of trying to dissuade him from, in some ways, I just wanted to make sure that he understood that if I took this on, that he was going to be loyal to me, was going to be a big part of it too, because.
So in that sense, it was closer to The Godfather.
Yeah.
Yeah. Which movie are we comparing this to? I guess I want to make sure.
It's just, when you take somebody on in any kind of a business, you're kind of mentoring them, especially for him. He didn't know anything about the industry yet, right? So I was going to be teaching him from square one. And one of the things that I fear a little bit, because I've done this before when I was in the real estate side of it, is I would take somebody I knew, pour my heart and soul into helping them, try to figure out how to become successful, and then them jump ship and go somewhere else. So, that's a little bit of a fear. And so I had that happen to me, as a real estate broker. And I was like, this could happen again. I could teach this guy to be really good at this industry. And next thing you know, he's off, being my competitor down the street. Right.
Yeah.
So that was something I kind of asked him up front and said, hey, what's that going to look like if things don't work out, I guess. Right.
Yeah. It's so funny. I don't ever remember you asking that. So I never felt that.
Maybe I did it very, very subtle.
Maybe. Yeah, probably. Yeah. Yeah. I felt super lucky that he took a chance on me, because I cannot overstate how little I knew about anything mortgage related. It is just an ocean of knowledge that you never stop learning. It's this living, breathing thing that is changing. Guidelines are changing, our content is changing. Risk assessment changes depending on our economy. It's just you need to constantly be evolving and learning more. So there's no way you could teach somebody what they need to know. And in a lot of ways, I just think Todd did it perfect, in that he brought me in. It's like, don't worry about how to write a loan. You will figure it out, and I'll be here. I'm not going to let you screw up. So when a loan does come through, it's a little bit like, I've compared it to like learning how to fly an airplane. But you start like 10,000 feet up, right? You start in the clouds. And the engine's off, the lights are off, you're free falling, and you have 30 days to figure out how to fly that thing, or we're all effed. That's kind of what it feels like. So that's, I think, the best way to do it, because every situation is just so nuanced and different. You couldn't possibly prepare for. I think my very first loan was a cashed out refi that went a little awry, and we ended up having to do like a home equity line of credit. In addition to, it was gnarly, man. It was gnarly.
You learned a lot on that first one, I'm sure.
I did, dude. I did.
We still talk about that one. It was a very super complex file.
What's the chances of that being the first loan you do? Well, I got a question for both of you guys, and I'm going to ask Kyle first, because I want to know, like, if you could rewind back time right now for someone maybe seeing this who's thinking about getting into the industry. Hey, I want to be a loan officer. Hey, they got that friend who had the best year they ever had last year, right?
Yeah.
You know, what are you telling yourself, you know, as far as like year one, you know, month one, like what's the piece of advice you would give to yourself if you could rewind back time? And I got the same question for you too, Todd, when I go.
Yeah. I kind of had a mantra starting since it was such a new world for me. I was really fearful of sort of like this identity whiplash of going from, you know, musician to corporate guy, sort of. I don't know. It's like this weird hybrid of corporate and not. I was really fearful of that. So as I was sort of analyzing the job, deciding whether or not it was something I wanted to invest time and energy into, if I had any sort of longevity in that first year, it's going to be the most painful for you the first year or two. It's like pushing a boulder up a hill, man. You have no referral base, especially if you're a transplant and you're not a hometown kid, right? I'm from Nashville. I don't know anybody in this industry. That's the hardest part. So I never allowed myself to make an assessment about the job on a really bad day or a really good day. I had to be in it long enough that the peaks and valleys took their time. And then I found homeostasis and I found sea level. And when I recognized what that was, then I could analyze whether or not this is something I wanted to do for a job. Because my emotions at least, just get way too jacked in sales, especially if you're desperate, you know, starting out, you need to make that loan close. Sure. It's very hard to be objective about the job itself. So that was helpful for me to hang on to. Is like, you got to wait for a sea level day. And it took about a year before I had one. It was just so up and down for a year. So
to kind of put it in a little bit of perspective, I think it's really important for someone that wants to pursue a career like this to understand that there's a delayed gratification aspect to doing this. It's entrepreneurial. And that's important to understand too. You're not going to succeed in this business if you're afraid to pick up the phone and go out and talk to people, right? You have to be willing to put yourself out there, be a little bit vulnerable, and even be vulnerable to making a few mistakes earlier on in your career, because you're going to learn. And the only way to get better is to make some of those mistakes, unfortunately, right? So you have to kind of be a little bit entrepreneurial. You got to be unafraid to pick up phones, talk to people. And if I could say, if there was one thing that I would have liked differently if I had started out, would have been to find a good mentor to work with, right? Under a really good, somebody who's really successful at the business already, so that you're not reinventing the wheel, right? Trying to figure it all out. I think that was probably for me, it took me a lot longer to get where I'm at, where I wanted to be, I guess, than it should have. I've watched Kyle in a very short time, 3 years now? Yeah, a little over 3 years that he's been in the industry, exceeding what most loan officers are doing in this industry already, right? So he had this mentoring. In those first 3 years of my career, I was at a credit union and I wasn't doing squat for business, right? It took me, well, I shouldn't say that. I was doing a ton of volume. I wasn't making any money. They weren't paying me very well. But when you go into the real world of this kind of a business, you know, you can write your own paycheck essentially if you're good at what you do, but you can't be afraid to go out and put yourself out there. So, you know, if you have that mentoring, it kind of reduces that learning curve, you know what I mean? Shortens the learning curve. And I think that would be the one thing I would say. Don't be afraid to go work for a good mentor first and then go out on your own. Yeah.
Not everybody's, and essentially Kyle working with you, right? You guys having the partnership.
Totally, man.
You, right?
Yeah.
It's so much.
It's so valuable that, you know, if you're a loan officer and you are worth your salt at all, there are going to be recruiters that call you, some local, some not, you know, there's going to be companies that want you. And I've had that as well. It's so apparent to me in those conversations, how important this mentorship is to me over any sort of compensation or pay, which puts that recruiter at an immediate disadvantage. So I'm just like, hey, I want to let you know, like, it doesn't matter if I get 250 basis points per loan, if you put me on salary, like, just all the value of this job right now and for the foreseeable future resides within my mentorship underneath this guy.
Yeah. And it's funny because one of the things that you look at in this business is like, you know, what are the things you've failed at, right? Or what did you learn from a failure that you had? I was heavily recruited after I got into my first year or so in the real direct lending world, right? And I started getting heavily recruited because my numbers were good, and they can see that. Recruiters know who's doing what out there. I took the bait on one of the recruiting calls, and they offered me a lot more money, per loan, basically, right? And it's very enticing, and you're like, okay, well, that sounds great. And I jumped ship, and I went there, and the culture just was not for me. The culture wasn't there. They didn't have the support. They didn't have the process that works for me. Very passive aggressive processing team and underwriting teams and stuff like that just wasn't a fit for my style and who I am. I like a nice, smooth process. I don't want to worry about, whether my loan is going to get to the finish line at the end. And once I've started it up and I've structured it. So it wasn't about, I learned I jumped ship out of that company very quickly. In 3 months, I called my previous company up, and fortunately I left on good terms with them.
Yeah.
And they opened the door. They left the door open when I left. And the CEO actually called me when I gave him my notice and said, "Hey, anytime you want to come back, you're welcome," which was really cool. Not to burn those bridges, but I went back to them and told them what I was hoping to, what could improve. And they did everything I asked them to do and ended up going back. But that was a mistake, right? It was a lead just because of somebody offering you maybe a little carrot that's a little bit more per loan, but it actually ends up losing money for you in the long run, right?
Right.
Yeah.
Because you're losing.
You
your
can't get to
partners.
closing then.
Yeah. We're destroying relationships with my realtor partners, and that's the ones that keep feeding you business are those realtors. If you do a good job, they'll send you more business. But if you do a crappy job, they're not going to send you another deal.
Yeah, and that's powerful, right? Because that's the entire business, right? It's your reputation, right? Your reputation and people referring you and people just send you more business, and the lifetime value you build with a good realtor or broker that's sending it's invaluable, right? Which is huge. Just to shift gears a little bit, because I do want to dive into the market that we're in today, right?
Yeah.
And a lot of guys are coming out of their best year ever, either loan officer, mortgage wise, and realtors, right? Everybody's having their best year ever. Where do you guys think the market's going? How do you see it impacting, the interest rates going up? How high do you think things are going? Obviously, nobody has a crystal ball, but maybe Todd doing this a little bit now. Like I'm not sure how many cycles you've seen, and you've been in the real estate game. So, like, what, in your opinion, where do you think we're going? Where do you think it stops? Like just give us some insight on just what you personally think, right?
Yeah, this it's obviously a very interesting time in this industry, right? And I have seen some cycles. I've been doing this, like I said, over 20 years now. So I went through the 04, 05, 06 market where things were just ridiculous. So 20% increase per year. 3 years in a row. And then I watched the market implode, and go south. And then we had dealt with that, that cycle. And now we're seeing another real estate boom, going up. I will say it's a very different market than it was in 06. In 06, the people, we created an artificial, I didn't, but the powers that be that do finance and the world had created this artificial supply and demand. Right. We had too many buyers qualified that really weren't qualified, actually, with not enough inventory out there. Right. This market is very different, where we have plenty of qualified borrowers, not enough houses for them to buy. There's just not enough inventory out there available to them. Right. So that's one problem that we've had. But that's a good problem to have as far as if you're a homeowner, because, you want is your investment to grow. Right. And this is an investment. Homeownership is an investment for people. And so it's going to grow in value still over time. So even somebody buying now, the worst rates we've seen since 2008, the last time we've seen rates this kind of high, there's still an opportunity to buy and own that home and watch your value increase. You're not going to profit as much as you would have if you bought and when your rate was down in the 2s and 3s, right? So you're going to see less of a profit, but still profit. And that's, I think, the big thing that people don't understand.
It's like that quote, what's the best time to do something 20 years ago? What's the second?
The best time to plant a tree was 20 years ago. Yeah. The best time is today. Yeah.
It's a little bit like that, man. The market, like, sure, you could say like, dang, if I just whatever.
Mm-hmm.
But
I posted a thing on, so we have this Facebook group that you can get involved in if you're a loan officer, right? Only loan, you have to have a license to get into the group, whatever, right? So my parents had given me their passbook of their mortgage when they took their mortgage out in 1970. And their mortgage was $15,000. I think it was $15,000 or $16,000 for their brand new home that they bought on 6 acres of land.
Wow.
Right. And so the perspective of it was a $16,000. You can't even buy a used car for that these days, right? Never mind a house on 6 acres of land. So it's again, that's buying even in this kind of a
What was
market.
the rate?
Oh, the rate was 7%, somewhere around there, right? And they were scared to death to make those monthly payments, And so it's all relative, right? They were making like, $1.50 an hour, I think, or something like that at the time. So it's just that having that perspective. So even now, buying in this market is a little scary, right? And the volatility of the rates is never fun as a loan officer. I had a guy last night call me and talk about qualifying him. He's looking to buy a home, and I qualified him back in November of last year, and he was qualified for over a $400,000 loan at the time. And I qualified him this weekend. He was looking to be updated. They finally are out there looking again, and I only qualified him for 330. He asked me, he goes, "Hey, back in November you qualified for 400. What happened? Why are we only 330 now?" He's making the same amount of money. He's got the same debt. Interest rates went up by over 2% since November, so that's why. Yeah. So it is part of the equation, right?
And connect the dots in case people aren't. It's your interest rate is a part of your housing payment, and your housing payment is a part of your debt to income.
Right.
And your debt to income is one of the largest metrics that's going to determine your top value.
How much you can afford to invest in a home, right?
Right. So if the rates rise, your housing payment rises, your debt to income rises, what you're qualified for lowers.
Yeah. And so in that case, it's, that you're not able to buy as big of a home right now if you keep in the same pay level, right? You're going to be able to afford less of an investment. We watch a lot of gurus in this industry as well to try to keep up with what's going on with the economy and what rates, where do we think they're going to go, right? A lot of indicators are indicating us heading towards a recession near the end of the year, early next year. And whenever we get into recessionary periods, the bond market tends to be more favorable, because people get spooked to get out of the stocks and get more into bonds. Well, mortgage-backed securities are based on bonds, not stocks. So they're all anticipating the rates to recover or get a little bit better, at least by the end of the year, early next year. So it's a cycle like everything else. We believe, and we could be wrong, right? We're not, we don't know, nobody can, we all have a crystal ball, obviously, right? But we don't. So, but all the indicators are pointing in that direction. So what we're telling most people is, look, don't lose the opportunity to get your home and make some money off this home investment. Plus you get use and enjoyment out of it, right? And one of the coolest things about home ownership is you can leverage other people's money to be able to buy this great investment and then live in it and use it and enjoy it and sell it for a profit later on. So it's kind of a cool thing, right? Using other people's money.
It's definitely, and it's definitely, in my opinion, I just think it's always the best time to buy, right? If rates are going to continue to go up, isn't right now the best time to buy, right? So it's always the best time to buy. And then, you just refinance, right? If the rates go down.
Honestly, even people that bought in 2006 was probably the worst time you could have bought real estate. They're selling their homes as long as you pay your mortgage and you maintain the home over time, you're going to make money at some point. Just not going to make as much.
Sure.
That's the bottom line. And yes, if they tried to sell if they bought in 06, tried to sell in 08 or 10, you're not going to make any money. You're losing money at that point. It's a long-term investment. So that's the difference.
Now, question for you. If I'm, super hypothetical scenario here, I'm a 25-year-old kid, got a 650 to 680 credit score. I had an interruption because COVID, I maybe lost my job, and a lot of people might be in the same position. Maybe I have 12, maybe 18 months worth of work. Like, what's the product, right? Like, and I know everybody's situation is always going to be different, but someone may be watching this. They may not even know that they even qualify. There may not be a product for them. So can you walk us through a couple of the products for, the average people? Not everybody's going to walk in with a 780 and, money in the bank. And so if I'm the average Joe Schmo working a job, making between 50 and 70K, somewhere around there. And I know super hypothetical. There's a lot of
it's not hypothetical at all. It's our marketing.
Yeah, it's totally our marketing. So, it depends on, there are so many risk factors that go into not only like your pricing, but what you're qualified for. So I'd probably go through some basics. Is there any non-starters? Is there anything in your financial picture that's going to be, conventional will not go for that? So we just take out conventional loans. Whack. Now we're looking at FHA or USDA. Did you serve in the military? No? Okay. VA's out. Whack.
Got it. Okay.
So it's a little bit of like narrowing down. Are there any unmovable hurdles that will make a loan program out? If not, then really we're running through as many scenarios as possible to try and accomplish whatever you want to accomplish. And typically, if it's a first-time home buyer, like you're saying, it's like, well, to buy this home around this price range and not lose my shirt in the process. Great. Okay. So oftentimes people will be qualified for more than one loan program. And what we like to do is break it out. Option A, door 1, door 2, door 3, pros and cons. What's good about an FHA loan? With your credit score, good thing about FHA, you get to put 3.5% down. With your credit score being, let's say, 650, your rate's going to potentially be a little more manageable than if you were to go conventional. Your mortgage insurance specifically will be a lot more manageable than if you were to go with a conventional.
With private mortgage insurance,
Right,
is much more rate credit score sensitive than a FHA.
Right. On a conventional loan. So stuff like that, those are the pros. The pros. The cons are you have mortgage insurance for the life of the loan. And it's there until you refinance out of it, which maybe you can do someday into a conventional if you get your rates up or whatever. So I like to totally lay it out and let the borrower advise them and let the borrower decide what's going to fit best for what they want to accomplish. I mean, normally when people say, my credit's not the best, can I get a loan? Like absolute basement level, for the most part, it's like 580.
I just closed somebody with a 583.
So walk me through. I know you can't talk about that specific line, but walk me through. If I'm a 580, like what's the product then for them? It's FHA?
Yeah. So FHA is definitely the loan program. Like I said, the one that will allow for lower scores. Okay. So it's a government backed insured loan, right? Mm-hmm. So this client was, realtor partner had sent him my way, and I did all the preliminary questions on the phone with him, and I asked him, what his job was, how long he'd been there, how much he earned, all the things that I wanted to make sure this guy, I'm like, oh, this is going to be great. This guy's going to be a nice, easy slam dunk file for me. It very rarely happens. So he gets in and gives me the application, puts it on, and then I pull credit. And his credit was 540 or something like that. It was sub 580 at the time. And so I was like, oh, geez, I thought this guy was going to be a slam dunk. Okay, he's not. So what we do in that case is mentor the client and give them, we know what to do to how to help people get their credit scores
because what's causing it because you're looking at the credit report.
That's something we've become pretty good experts at, I would say at this point, is how to help people get their scores up, right? And so in this case, I'm looking at his report and I know what he has to do.
It's like, hey man, do you owe T-Mobile $75?
Yeah.
It's like, screw them.
They do.
I was gonna say, is it like typical just utilization, or is it just them not paying their bills or something?
Well, some of it's just some is dumb, right? Yeah. It is. Like I have an attorney right now who's got 618 credit score because she refuses to pay her $75 Kohl's card.
Oh, for real? 75?
Yeah.
I just pulled that number out of it.
Yeah, and I'm like, no, pay the stupid Kohl's card off. Yeah, but I'm like,
there are some people who want to die on that hill.
So it's simple stuff they just need to get over, pay it off.
A lot of times it is. Yeah, a lot of times it's just not understanding how credit works. A big one that really kills people is utilization of credit on to their limit. So if you have $1,000 limit on a credit card and they're putting $800 on it, that's tanking their scores unbelievably. I don't agree with that, by the way. I don't think that should be an algorithm anymore. That's something that's antiquated in credit. How people use credit these days is very different than they did 20 years ago, right? Yeah. I don't make the rules, though. I just know what they are. But what I know, I do it myself, is that most people these days are utilizing credit. They put everything on it for the points and the miles, right, on their credit card, and then they pay it off at the end of the month. There's nothing in the credit scoring model that adjusts for that.
That's true.
So there are people that don't realize how important it is to have high credit limits on their cards and use less than 30% of that limit. So they'll be out there using, 90% of it. They have a small limit, $1,000, maybe because they're trying to protect themselves. They don't want to have too big of a credit line, right? And then they'll max it out and their scores are being tanked. So I'll say, get your credit paid down under 30%, and your score is going to rebound in the following month. It takes 30 to 60 days for that score to rebound. But if they listen to us when we tell them that, their scores rebound very quickly. And that's what happened in this guy's case. I said, look, do this, this, and this, and your scores will rebound. And it did. It only rebounded to the 583. And I told him, I said, I can get you now. He says, yeah, if you can get me one, let's go now. I'm like, okay. So he didn't care. You know, he knew that this would be an opportunity to buy a home. And someday, if he doesn't like what he got for a rate, he'll refinance. And by the way, he ended up with a decent rate because he paid points. In this case, you can buy down a rate if you want to. And he had cash. So he was able to buy the rate down to a reasonable rate anyway.
How long did it take for the scores to get up?
He was about 3 months for them.
Oh, interesting.
Yeah.
It's like, so I was just thinking about that. You said it only went up to a 580, so it made him qualify. But credit, one thing that Todd taught me when I was first kind of learning about credit in general is that it's this rubric of behavior.
Yeah.
And behavior takes time to analyze. So it's, you know, if you're late on your bills and then you're not, it's going to take more than one cycle for this algorithm to recognize that as like enough that your score is going to be reflected and continue to improve.
Yeah, I think the scoring models are there for a reason, right? They are predictors of behavior. Like, what's the likelihood of somebody repaying their loan if they don't pay their Kohl's card, right? And will they just find an excuse why not to pay us?
Sometimes that can be a guideline as well, like the kind of credit that you have with a certain loan programs. You know, you need to have at least 2 trade lines for over a year, not one that has been less than that. Or specifically, underwriters might get caught up on a lack of installment loans. You have a lot of credit cards, but you've never done a fixed, like amortized installment loan before that you've paid back. So we have no history of your behavior on that kind of debt.
So yeah, they're looking at all of those things. So, and again, we try to coach our clients to try to help, because the higher their scores, the easier it is for us to get them a loan too, by the way.
Yeah.
It was a little selfish on our part, I guess, right? We truly are trying. If we don't close loans, we don't make any money. So we do have to get to the finish line.
You know what I'd like you to walk me through something most people don't talk about. You know, if I'm someone who's reaching out, because right now most people need a pre-approval right before they could even look at some of the properties.
Yes,
right?
absolutely.
I don't know if it's like that in your area still.
It is.
Or not, but if I'm someone, you know, either my realtor's sending me to you, right, or B, if I'm a referral, it may just be like, hey, call my guys at Supreme and just get a pre-approval before you even start speaking to any realtors. Because I know that's what I tell a lot of my people in the area in North Carolina. It's just like, hey, here, call so-and-so and so-and-so, see if you get pre-approved. Don't waste anybody's time, you know?
Right.
And so if it does happen that way, like walk me through like the process. Like I'm your customer, you know, what's it like working with you guys? Like I come to you guys, whatever the credit score number is, you get me a pre-approval letter. You send me back to the realtor to find a home, right? I find it. I come back to you guys again. Walk me through like the normal, like what does the customer journey look like? Are we closing, getting things wrapped up in 30 days, 90 days? What does like a typical, you know, journey look like for you guys?
Yeah, that's a good question. So it's going to obviously be different for everybody, a little bit different for each individual, right? Because everybody has unique need. What you learn in this industry is we get to see everybody's life behind the scenes, at least, right? We're seeing their financials, their credit. You know, we know things about them that their spouses don't know sometimes, right? They find,
imagine.
right? So
I see this savings account over here. Like,
yeah, what is this right here? Yeah.
So you get some interesting scenarios. Honestly, the first thing we're trying to really establish when we're meeting with a client is to try to find out what their needs are, because everybody's got a unique situation that they're trying to do, right? Could be a second home that they're looking for, could be their first home, could be an investment property, could be a multifamily or a condo, and there's so many different things, right? So we have to establish that first, right? What is it that you're trying to do, right? What is your objective?
Or a refinance.
Or it could be a refi altogether, right? What is it? And even then, you know, some people are like, well, this is not a good time for refis. Well, that's true, but I just did a refi for somebody, and I saved their over $700 a month when she did a refi, even though the rates were higher. She had a high rate. I gave her a comparable rate. Actually, she didn't really get a better rate because rates had gone up, but we paid off a ton of debt that was holding her down. And we got her some money to be able to do some renovations on her home. And that was more important to her than paying her house off, right? She was leveraging up money to move forward in life. And it was actually saved her. She was able to get all this money, fix her house up, and save $700 a month. So that's a cool story on a refi, right?
Yeah.
So it's not one size fits all every time, but she had a ton of equity in her house. So that was good, a good win-win. But so what we're trying to do is establish red flags in our first initial conversation, right? I want to ask some real basic qualifying questions when I'm, build a little rapport with them first, right? Get to know them, how to get to meet us, and then start asking them some very important questions about, what do you do for income? How much money do you have saved up? All of the questions that we're asking them are kind of calculating in our brain, what kind of loan program are we going to start pointing these people to? Well, how can we help them get to the finish line?
And the more thorough that initial interview is,
this is important.
The faster that process is that you're talking about is, like when they have an offer accepted and then we hit the ground running. If the loan officer did his job on the initial interview, it should be cake.
And what Kyle's talking about is something that we learned the hard way in this industry is if you don't ask enough questions early on, it can bite you in the butt later on, right? So that can really be painful. You really want to vet that client out really well and understand their situation very thoroughly and think like an underwriter. At the end of the day, there's an underwriter at the end of the loan who's responsible for ensuring that there's no fraud going on, making sure the loan's quality, that that we've crossed our T's and dotted our I's, and they're there to protect the investor and protect the industry in general. So you can look at them as the enemy. Some people do. We don't. Our underwriters are phenomenal here at Supreme. That's one thing I got to say. We have the best underwriters I've ever worked with in my career. So we're very fortunate to have that because they can make or break you if they're not good at what they do. But we still have to understand what they're there for. They're evaluating risk. And so the cleaner we can the more questions we ask up front and the more information we can get from that customer and make sure we're telling a very good story to the underwriter, the better chances that loan's going to close at the end. So we do a lot up front, making sure that we have that correct. And then the process is pretty streamlined once we do get them approved. We get them approved, we give them their letter so they can start working with the realtor partner. That's what we're kind of hands off a little bit once we start that piece of it, once we've approved them. We give it off to the realtor. The realtor then goes out and does their thing, which is hard in this market, right? This is probably the biggest challenge that we have as loan officers right now. I've got a lot of people that I have qualified. Kyle has a lot of people qualified. They're making offers and not getting them accepted, right? So there's a lot of work for the realtor to run around, show 100 homes to these people, make 5 or 6 offers and get them all rejected. That's tough, right?
And when the search goes beyond like a quarter, then we as loan officers need to start being aware of expiring documentation.
Yeah, credit scores.
Specifically credit reports. And it's going to be different for every client. Like some clients' credit profile is going to be sort of hairy enough that you're going to want to update that when it expires. And others will be clean enough that you might not need to update and do another pull.
Although you had that happen to you with one client.
I did have that happen to me. It's based off of conversation. Like everything felt strong. I don't want to unnecessarily pull because what if it's another quarter and then another quarter and then another? We have people who look for a year and a half before, man. Like you don't want to pull every 4 months if you don't have to.
Yeah. Of course.
And just keeping the conversation with our clients, thought everything was gravy. Wham, 80-point difference. Like now we're no longer qualified for the loan program that their offer was accepted upon. So that's the only hairy thing.
And by the way, there's some confidentiality in this industry too, right? So if I find out information about you that you've had a recent, a bankruptcy 3 years ago, I can still give you a loan, but I can't tell that to the realtor partners. Hey, this guy had a bankruptcy. You know what I mean?
It's just like,
yeah. So the same with this, so this is a situation where, Kyle had a client who forgot to pay a Kohl's card or something stupid like that. It was another one of those dumb things.
Yes.
He tanked his scores 80 points and he didn't qualify for the same program that he had previously pre-qualified for. Had to repull the credit.
Yeah.
Well, now you can't go back to the realtor partners and say, well, this guy didn't pay his bill.
Oh, right. Oh, sorry. There was a student loan out there that I didn't pay.
Yeah.
We didn't know about it until this came out. So
it's a delicate balancing act out there, right? We try to keep that relationship and the trust factor with realtors, and yet you still got to have this confidentiality too.
Assuming all that's up to date, though, it's once the borrower's qualified and they get an offer accepted, that's the easy part for us because of the process that we created. So our processor, Kelsey, is actually my wife. And she's amazing at what she does for sure. When we get an offer accepted, signed contract, it goes to Kelsey. A story about the loan and the borrower and the agents involved go out to Kelsey. And then really Todd and I move into quality control at that point. And Kelsey is facilitating everything. She's reaching out to the borrower. She's getting any missing documentation, W-2s, pay stubs, bank statements, whatever. And it moves into underwriting. The appraisal is ordered, title work is ordered. It's just all very, very quick and automated. We hit our closings on time because of that.
Yeah, we close typically in under 30 days. We can close in much quicker than that, depending on a few things. The biggest thing that slows us down, title and appraisals. We don't have control. Those are third party people that we have to hire to do their job. And
so that would be like best case, right? 30 days if everything's pretty smooth, right?
That's about normal for us.
About normal. Yeah.
For us, 30
If we have a
days.
situation where it needs to go faster, I mean, we can do our stuff, our end really, really fast. But like Todd said, there's so many parties involved that you don't have autonomy over how long the attorney takes to do title work, right?
So as we wrap things up, I obviously, us being a marketing company, right, and us doing your marketing and being biased, but as far as like marketing in the industry, right, like where do you guys kind of like? Well, I guess for Todd, how has it changed since you first started?
It's a great. I'm going to tell you my side real quick. I'm run with it because this is one of the nice things about being the old guy and having a young guy with his, that you're mentoring, right? Because he can mentor me on the marketing, social media stuff too, right? But yeah, it's evolved dramatically, right? Since I got in the industry. Mm-hmm. But you think about it, I got in the industry in 2003. The internet really was just kind of in its very infant stages, which sounds really weird to say right now, right? It's like, holy crap. Yeah. But it's true. It really wasn't something that was where it is today, the power that it has. And what we did to market back then was you put ads in the newspaper. Eventually you put something in, and ads were always driven towards, hey, I am a lender, send me your business, right? Where it's evolved now, and this is what you guys have actually helped us understand at FMO, which is great, is that it's not just one thing. You don't just put out an ad anymore. It's this platform of consistency across platforms, right? These different social media things and doing different things and getting your message out in a variety of ways. Mm-hmm. And I think that's been the biggest eye opener for me. Kyle and I have started doing some of these things, TikToks and stuff now that are fun and funny. And it's been really incredible to see the reaction that we're getting from realtors that we are already connected with, right? They started to pay attention to us more. And I'm like, wow, this is what it's about. And kind of a little light bulb went on in my head. I'm like, this is why we do this. Now it sticks, right? We're kind of branding ourselves with them as the guys in the industry that do this stuff, right? And we're top of the mind with them now more than we ever were. And more than any Facebook post that I would have put up or single ad that I would have put in a newspaper, this has been something where we're getting much more engagement and reactions and people telling us when we're on the phone with us, oh, that TikTok you did was really funny. So that's something that's really cool to me.
Yeah. Yeah, man. I have so many thoughts. I'm trying to like weed through, but I'd say that our main goal at this point is really simple and top of mindness, like beyond getting on like really like chiseling in on what our brand's going to be. Like that for me feels like secondary or tertiary to the initial drive, which is just I was telling Todd this, like I gave him a little challenge last week. I was like, look, man, I want you to shoot a video and post it on whatever social platform you want. It could be, hi, I'm Todd, and the video, post it. Because I think the biggest pain point, the biggest hurdle is just hitting send on the platform and being able to cross that threshold and know it's going to suck for a little while until you get your feet and figure out what it is for you. But the old school marketing would show what company you worked for and what you did, right? If I'm sitting at a restaurant and there's a menu there and I see, oh, there's Keith and he does loans. Okay, cool. It doesn't tell me anything about who that person is. And that is what is so amazing to me about social media. When I first started this job, Todd gave me one task since I don't know anything. He's like, call 25 agents a day. So I'd go on Zillow, I'd type CT in the state, and then there would be a list of 20,000 agents that would pop up and I'd just start calling through. And I hated that. Everyone hates that. I hated it because I didn't know how to write a loan. And when I'm calling these agents, what I'm asking them to do is to take a chance on me with their paycheck.
Yeah.
They don't get paid if we don't get to closing.
Mhm.
And I couldn't get behind that. I just couldn't, like, I don't believe in myself. I'm not going to ask these people to believe in me either. So I started to shift my goal into, I just want these people to get a little bit of an idea of who I am. So when I would make my calls, the goal would be coffee, not a deal. Don't send me your business. Just let's have coffee. We might not get along at all, or we might. So then I started doing that, and it worked really well for me. And I learned that realtors don't work with companies, they work with people they vibe with. Social media is this giant hand and this huge tool that allows us to express who we are as people when we're unable to get that coffee yet. And what I've seen it do is open up doors, so that I had coffee with an agent the other day who agreed to meet with me purely because of some of the content that they were seeing online. That's massive. I want to give a shout out, number one, to you and your company, man. I think you guys are doing an amazing thing. And also just to Delaney, who has been I think like one of the most organized, efficient, kind people I've ever worked with in any industry, man. Like, she's really helped to corral in a bunch of like wild waving thoughts that are hard to like point in a specific direction. And that's a huge strong suit of hers, is she hears all this cacophony of ideas and bullshit and then able to push it where it needs to be. So if I can give a shout out to Delaney, I will. She's great, man.
Awesome. Well, I'll have to make sure we play that clip for her. Any last minute thoughts, tips, words of wisdom each one of you have for anything, the market, a future customer, a potential future loan officer joining in, and anything about anything?
I think I want to give my advice to any potential loan officer who's in it right now, maybe, or looking for a change or dealing with changing markets. I heard this quote, and at the time it was related to jujitsu, but I think it's really applicable here. That it's not about who's best. And let's say that's in terms of volume, maybe your numbers, your pipeline, your annual income. It's not about who's best. It's about who's left, particularly with an industry like this. Like, can you create systems and time blocking that's repeatable and sustainable, so that as the economy goes up and down, you're just doing your thing. Just put your head down and keep doing your thing. And over time, your tide, I believe your tide just rises and rises and rises and weathers those valleys a bit more. So,
Yeah. And if I have something to add to that, I would say anybody that wants to get into anything like this kind of a business, even if it's in real estate, is to still have a life outside of what you do, because that life outside of what you do will generate you income as well. You know, I always remember this one particular story, because I think it's really cool, is that I took a golf lesson once because my dad was getting up in age and he liked to play golf, and he asked me to go out with him more. And I said, okay, Dad, I'll go out with you more. I'm not a good golfer. So I said, well, I'm going to go take a lesson now so I can get a little bit better at it. So I took a lesson with this golf pro. And as I got to know the guy and talk to them, he trusted me, and he found out what I did. And he asked me to be his realtor when I was in real estate to help him buy a home. So taking a golf lesson actually got me a business, right? So being out there, being present, being in the community, don't stop doing the things you love, and manage that, all of it, because otherwise you're just going to work yourself, to death. And for what, right? It's not worth at the end of the day, you want to still enjoy life too.
he told me that early on when I started, by the way. I was like, do I need to quit the drama club? He's like, no, don't quit.
That's funny. Well, that's similar to the story you just talking about. You were taking people out to coffee, right? People sell out to people, right? They don't sell out to companies or things. It's the relationship. So that's huge. And no wonder you guys are doing so awesome, because we jumped on here and I feel like we're like friends already. We get to know each other. We just vibe right. You guys seem cool to just hang with, I'm sure. I'm saying on an everyday basis, grab a beer with. So thanks for jumping on, guys. I wish you the best. Make sure to follow them. All their links will be down below, so you can give them a call. Make sure if you're in the area to reach out to work with either Todd or Kyle. They obviously kick butt, and they're awesome people to work with, and they're super knowledgeable, which is most important, and they're going to do the right thing by you. So until next time, everybody.